All right, let's jump right into this explainer. Because every single time you tap your phone to pay for coffee or split a dinner bill, or even just check your savings account, you are participating in a massive, mostly invisible battle. It's an all-out war between traditional legacy banks and agile fintechs, and it's absolutely reshaping how money moves around the globe. So here's how we're going to break this down today. First, the legacy tech trap. 2, fintech's CX advantage. 3, metrics that actually matter. 4, the compliance reality. And finally, building the future. We're going to peel this topic back layer by layer, starting with the big foundational shifts, zooming right into the hardcore metrics, and then wrapping up with the actual, on-the-ground reality for the people building these products. Section 1, the legacy tech trap, and how exactly these giant banks are trying to escape their own old systems. Look at this stark gap in unit economics. It really paints a picture. At their core, legacy banks are running on mainframes that were literally designed 40 years ago as digitized ledgers. Because of that ancient tech, they're shelling out roughly £150 per customer, mostly just to keep the lights on. Compare that to cloud-native neobanks, running at about £20 per customer. And the agility? Night and day. An incumbent bank might throw a party for getting a tech update out once a month, while a neobank is pushing updates to your phone tens of times a day, every single day. Now, you might be wondering, well, why don't traditional banks just upgrade? Actually, it's a nightmare. Take the popular lifeboat strategy. The idea is you build a shiny new greenfield tech stack on the side and slowly move your customers over. Sounds great, right? But the reality is that over 40 years, banks have buried mountains of undocumented edge cases into their code, stuff written by developers who retired 2 decades ago. If a bank tries to move millions of customers and hits one of these buried landmines, the whole system could crash. And in banking, a system crash is practically a death sentence. Moving right along to Section 2, Fintech's CX advantage. Let's look at what digital-first finance actually means for us. Just look at this number, 99.8%. That is the staggering percentage of transaction volume in India that was purely digital in the first half of 2025. Driven by mobile wallets and real-time payment rails like UPI, digital-first isn't just some niche thing for early adopters anymore. It's the absolute default. It's fascinating to see where the battle lines are actually drawn here. Fintechs are totally crushing it on speed. You can open an account on your couch in 5 minutes, while a legacy bank might still make you visit a physical branch. Fintechs are also running laps around traditional banks with real-time, AI-driven personalization, while the old guard is still, running pilot programs. But, and this is a huge but, traditional banks still hold a massive trump card, customer support. They have deeply established human channels. When your money goes missing, you want to talk to a real human being, and customers inherently trust traditional banks more for that. All right, Section 3, metrics that actually matter. Let's dig into the unit economics. Here's the thing, running a fintech is absolutely not your standard SaaS playbook. If you think your customer acquisition cost is just what you're paying Facebook for ads, you're gonna fail. Hard. In reality, you've got strict compliance rules. Know your customer and anti-money laundering checks easily cost $5 to $25 per user. On top of that, 30 to 60% of people just drop out of the onboarding funnel. They get bored or frustrated and quit. So a $40 marketing win can literally balloon into a $120 expense just to get one verified user. Which brings us to activation. In this space, signups are incredibly deceptive. An account creation means absolutely nothing to a company's bottom line. True activation, that only happens at the critical point of the first funded account or the first transaction. Simply put, if money doesn't move, your sign-up metric is just a really expensive vanity number. And this ratio right here, this separates the real players from the guys with just flashy pitch decks. For neobanks, up to 60% of created accounts might just sit there, completely empty. Wealth tech does slightly better, but it's still a massive problem. This is why reducing friction is absolutely crucial. Dropping a minimum deposit requirement from $100 down to $25 can be the single biggest hurdle an operator clears to start driving real, actual revenue. And user expectations for how fast that money should move have completely skyrocketed. Back in 2022, waiting 24 to 48 hours for an end-of-day batch process was totally normal. Fast forward to 2026, real-time payment rails like FedNow and SEPA Instant have totally killed that old-school cadence. If your app takes 24 hours to settle a payment today, your customer service inbox is going to explode. Reconciling payments in under an hour is basically a mandatory baseline now. Which leads us to Section 4, the compliance reality. Let's look at the regulatory burden these teams are under. In regular tech, product managers optimize for engagement, right? But in fintech, they optimize for survivability. Get a load of this story. A product manager at a neobank shipped this brilliant one-click savings feature. It was a massive hit, instantly boosting opt-in rates by 37%. Huge win. But 2 weeks later, the entire feature got completely pulled. Why? Internal audit flagged it as a potential UDAAP violation. That's an unfair, deceptive, or abusive actor practice. The PM didn't clear it with compliance first. It just proves that in finance, you absolutely cannot bolt compliance on as an afterthought. And honestly, building out those risk features is a grind. Dealing with anti-money laundering alerts is a massive operational drain. For a lot of mature operations, 80% of an analyst's time is wasted reviewing false positives. So the goal isn't just trying to catch bad actors, it's tuning your systems so your team isn't completely drowning in false alarms while still keeping the regulators off your back. I love this quote from a hiring manager at a top digital bank. Not agile velocity, but audit trail completeness gets you promoted. It perfectly sums up the reality on the inside. You don't win in fintech by dreaming up flashy, fun features. You win by understanding how a payment rail actually hits the general ledger. Surviving audits and mitigating risk matter so much more than how many agile story points you burn down this week. All right, final section, number 5, building the future. How are the incumbents actually upgrading their legacy cores? So remember that super risky lifeboat strategy we talked about earlier? Well, to avoid a total disaster, smart legacy banks are adopting what's called a brownfield thin slice approach. Instead of trying to rip and replace the whole bank at once, they take just one vertical product, like a basic savings account, and they rebuild just that thin slice on modern tech. Once they prove that works, they take another slice. Slowly but surely, they absorb the speed of a fintech without risking an apocalyptic system crash. Ultimately, once you understand these hidden constraints, it completely changes how you look at the apps on your phone. The next time you hit a weird delayed payment or some clunky onboarding screen, you really have to wonder, is your bank optimizing for your digital experience, or are they just desperately trying to survive their own 40-year-old legacy code? It is a fascinating question, and it's the exact dynamic that's going to decide the winners and losers of the financial sector for the next decade. Thanks for joining me on this explainer, and keep questioning what's really going on behind your screens.